Alright, so we mainly talk about return and risk more frequently. I'll talk a little bit about uncertainty in a second. The return is basically the percentage change in the value of each share of stock. For example, if we buy Apple for $150 per share and it goes up to 165, our percentage return would be positive 10%. The risk is how variable that return is. One way we measure risk is the standard deviation of past returns. If Tesla's stock price, for example, fluctuates between $100 to $300 over a few months, that means it has high volatility, which also means higher risk. If a stock like Coca-Cola, on the other hand, fluctuates between $55 and $60, its standard deviation is lower, meaning it's safer in terms of price stability. There are a lot of assumptions underlying the use of standard deviation as a measure of risk, but the main benefit is that it makes most of the math very tidy and pretty. But it's not the only way to measure risk. There are other things like downside variance, shortfall probability, or value at risk that aren't as nice statistically, but we've chosen standard deviation given those assumptions and benefits. Now, besides return and risk, we have the idea of uncertainty. What is this? You can think of it as the unknown scenarios that exist outside the information you currently have. You might have all the data about companies' financials, earnings, and past performance, but there are still things you don't know, like whether the CEO will resign or if a global recession is incoming. So, one way to understand the difference between risk and uncertainty is using a dice as an example, as we can see right here. So let's say you have a 6-sided dice, but 5 sides show numbers 1 through 5, while the 6th side, like this one right here, is blank. You don't know what that value is until you roll it. The numbers 1 through 5 represent risk, the known probabilities you can measure, but the blank side is uncertainty, something completely unknown that you can't estimate beforehand. This distinction is crucial because in the stock market, risk can be calculated and managed, but uncertainty is unpredictable. Things like geopolitical events, natural disasters, or unexpected changes in market sentiment, or such as a CEO resigning, these are all unexpected changes in market sentiment that can change up investments in ways that are difficult to model. Now, let's talk a little bit more about the trade-offs between return and risk. The trade-off between them is kind of what we're after when we run a quantitative investment framework. If we assume investors are risk averse, meaning they want a higher return per unit of risk, that's what we call rational investors. So people like you and I, hopefully, we are rational investors. Another way to think about risk aversion is that investors want to minimize risk while maximizing return. For example, if you have 2 investment options, so for example, here we have Nvidia, which has an expected return of 22%, but comes with high volatility. And the other option here is TSM, which has an expected return of 22%, but is more stable. A risk-averse investor prefers TSM simply because it comes with lower risk. This doesn't mean risk-averse investors don't take risk at all. It just means they want the highest return relative to the risk taken. This simple concept underpins the logic behind portfolio construction optimization, 2 major components of your typical quant model structure. On the other hand, we have risk-seeking behavior. A classic example of this is, buying lottery tickets or playing casino games. People in these cases are willing to take on high levels of risk despite the low probability of winning. If we plotted every asset or portfolio on a return versus risk chart, the most desirable ones would be the ones higher up on the graph. So like we've seen here, Nvidia and TSM. Imagine a graph like this, right? That we have return and risk plotted against each other. Now, the slope of the line connecting these assets represents the return to risk trade-off. A steeper slope means an investor is getting more return per unit of risk, which is ideal. And you can see that for Nvidia and also TSM. All right, let's dive a bit deeper into this whole risk concept. The total risk of an asset or portfolio can be broken down into two main components: systematic risk and stock-specific risk, otherwise known as non-systematic risk. Let's start with systematic risk. This refers to the risk that affect the whole market, things like interest rates, inflation, recessions, or geopolitical events. No matter what stock you own, these risks will have some impact on your portfolio. A great example is the 2008 financial crisis. Almost every stock in the market declined sharply because the entire financial system was under pressure. Even well-managed companies saw their stock prices fall, simply because systematic risk cannot be diversified away. Now, let's take a look at non-systematic risk. This is company-specific risk, things like earnings reports, management decisions, product failures, or fraud, individual company information. For example, when Facebook, now Meta, when they released their earnings reports back in 2022, their stock plummeted by 25% in a single day. But that didn't mean every stock fell. This was an issue specific to Meta's business, but not the entire market. The way investors manage these two types of risk is very different. Systematic risk, for example, you try to hedge against it by holding a mix of assets or even shorting stocks to offset exposure to market downturns. And in non-systematic risk, you can reduce it through diversification, owning many different stocks, so no single bad stock can hurt your portfolio too much. One key measure of systematic risk is beta. Beta tells us how much a stock moves relative to the market. So here we've plotted the return of the stock on the y-axis and the return of the market on the x-axis. If the S&P moves up by 1% and the stock moves up by 1.2%, that company has a beta of 1.2, meaning it is more volatile than the market. Hence, these ones you can see right here would all have a beta above 1.0. Understanding beta helps investors decide how much exposure they want to systematic risk. If you want a stable portfolio, you might choose low beta stocks. If you want higher potential returns, you might invest in high beta stocks, but with the expectation of more volatility. This systematic risk, measured by beta, is a fundamental concept in stock investing and risk management. It's something every investor has to grapple with. I hope you enjoyed this video. Thank you. Bye-bye.